Hi everyone, happy Friday Money Wind Up. If rates go up again in 2026, how much will your borrowing power drop? Let's not sugarcoat it. If interest rates rise again in 2026, your borrowing power will drop. The only question is by how much. And for most people, the answer is more than you think. So why does borrowing power shrink when rates rise? Lenders don't just look at what you earn, they stress test your loan at a higher rate to make sure you can still afford payments if things tighten. So when actual rates go up, your real repayments increase, your buffer serviceability shrinks, your bank reduces how much they're willing to lend you. It's not a gentle adjustment either. It compounds really quickly. So a simple example, say you earn 120 grand in your house. Your current borrowing power at 6% is around $600,000. If rates rise by just 1%, borrowing power could drop to somewhere between $540 and $560. That's a $40,000 to $60,000 hit from, a 1% rate rise. Admittedly, it normally goes up by about 0.25%, so it gives you a bit of leeway, but it is going to drop. Push that to a 2% increase and suddenly you could lose, $80,000 to $120,000. Same income, same lifestyle, less buying power. So why does this feel so aggressive? Comes down to how banks calculate your repayments. Higher rates mean bigger monthly repayments, less surplus income after expenses, and lower loan approval limits. And because loans run over 30 years, even a small rate change massively shifts the total repayment profile. What's the hidden trap? Waiting. A lot of buyers sit on the fence thinking, I'll wait and see what happens. But here's the catch. If rates rise, your borrowing power drops. If property prices rise, you need more borrowing power. You can get squeezed from both sides. Currently, property prices are going up from between $8,000 and $10,000 a month. So the longer you wait, the more you've got to borrow. Who gets hit the hardest? Rate rises don't affect everyone equally. They hit hardest if you are already near your borrowing limits. You have dependents, you have existing debts, so credit cards, car loans, HECS debts, or you're buying at the top of your budget. And really, most people are. So in other words, most buyers. So what can you do about it? If rate rises are a possibility, timing matters. You can protect your position by getting pre-approved early, lock in current servicing solutions, reduce unnecessary debts, get rid of them. Those credit cards, reduce your limits. You've got a car loan, pay it out faster. Although I'd rather see you with a loan, a fixed term personal loan, than a higher credit card limit. Get rid of any pay in for or zip pays because they all make a difference. You need to structure your loans strategically. Don't just chase the lowest rate. And understand your real borrowing ceiling now, not later. So the bottom line, if rates are going up, your expenses are probably going up as well, particularly at the moment we're looking at fuel rises. It's all going to be taken into account, and when they look at your borrowing capacity, they look at what your expenses are. And if they continue to rise, then they will increase what they expect you to be spending. So if rates go up again in 2026, your borrowing power won't just dip, it can drop sharply. And the frustrating part, there's nothing you can do about the rate itself, but there's a lot you can do about when and how you act. So everyone, it's Easter. Happy Easter. Have a great weekend.